This is a debrief of Task 3 from Sample Assessment 1 of Audit and Assurance. So Task 3 is about the planning process for the audit. So we're provided with quite a bit of information for this question. I noticed that we got 25 marks, so this is going to take up a quarter of your time. So it's quite a big chunk of the assessment. So let's try and digest some of the information they've given us. And remember, given that we've got so much information, trying to absorb it all is part of the skill you need for the assessment. So we're told that Roadho Limited is a private limited company that operates as a dealer of new and used cars. The company also offers maintenance and repair services to its customers. All customers are expected to pay for their vehicles in full on delivery or collection after repair. So it is 24th of February 20x4 and the company's year end is 31st of March 20x4. So we're just a couple months before the year end. You've been asked to assist with the audit planning for the upcoming external audit expected to start in May 20x4. This will be the first year your audit firm will conduct the external audit. So there's a bit of a risk there, isn't there? Because if we have not done the work before, then we may lack familiarity with this particular client, and that causes a detection risk. The audit partner recently attended a planning meeting with the finance director who does not have formal accountancy qualifications. So there's another potential problem, isn't there? That if the finance director doesn't really know what they're doing, then they may make mistakes. So that would be a control risk. They provided you with the following notes and extracts from the management accounts prepared up to 31st of January. So notice that's 2 months before the end of the year. The audit partner decided that materiality should be 0.5% of revenue. So there's a number in the text, so that means we'll need to use that somewhere in our answer. And we want to round down to the nearest £1,000. And we should assume that revenue accrues evenly over the year. So we're also provided with some notes as well. Let's have a look at those. So in April 20x3, so that's almost a year ago, isn't it? The client took out a £4 million bank loan. The bank loan is repayable monthly over 20 years, and interest is charged at 5% and is paid monthly. And that's separate from any capital repayments they're making. So remember they're repaying that over 20 years as well. The company is using the bank loan for extending and refurbishing its business premises. The work is expected to be completed by the end of May 20x4. So that's the period that we're going to be doing the audit, isn't it? So here's the management accounts. So we've got last year's and we've also got the 10 months for this year that have occurred so far. And we're given a variety of bits of information. We've got revenue, cost of sales. So there's no interest, is there? But we know there should be some interest because they've taken that new loan. We've got net profit before tax, property, plant and equipment, current liabilities and non-current liabilities. So that non-current liability is relating to this loan, given they took it out almost a year ago. So we're asked then, part A, identify the correct materiality calculated using the audit partner's instructions. So remember that they use 0.5% of revenue, and we've got revenue for the 10 months of 26,532. So we need to work out what the materiality should be. So we're told that planning materiality should be 0.5% of revenue, and they've given us revenue, and that is 26,532, but that's only for 10 months, isn't it? So what we need to do is expand that to cover the full year. It told us that we can assume that revenue accrues evenly. So if we take the 26,532 and divide by the 10 months and multiply by the 12 months, so that would give us 31,838.4 for the full year. And that's our expected revenue. And then to work out our materiality, we want 0.5% of that. So if we multiply that by 0.5%, that gives us 159.192 thousand. And it told us we should round down to the nearest thousand, so that's going to be 159,000 in total. So in the drop-down menu, we can see that there 159,000 is one of the answers. Next then, to assist the external audit partner in preparation for planning the audit of Roadho Limited, explain 3 areas of audit risk that could have a potential impact on the financial statements. And there are 6 marks available, so we need to make sure we write enough to be able to get 2 for each of the risks. If we only say one thing, that's going to be 1 out of the 2, and that's going to be a fail. Remember, we need 70% to pass, don't we? So we've got space for the 3 risks here. And then notice in part 3, describe the audit procedures and other steps that should be undertaken to reduce each risk identified above to an acceptable level. So there's a link between part 2 and part 3 of our answers. Now we all have different brains, don't we? And we all think in different ways. But we'd recommend that once you've identified risk 1 and you're thinking about that risk, it would make sense that you also prepare the audit procedures for that risk then. Rather than doing 3 risks and then 3 procedures, that means your brain's jumping around quite a lot, isn't it? So hopefully your brain will cope better if you just focus on one risk at a time. So let's quickly revise what an audit risk is. So an audit risk is the risk that we give the wrong opinion on the financial statements. But it's not any old wrong opinion. It's where we say the financial statements give a true and fair view, but actually there is a material misstatement. So we don't give opinions on the operations of the business. We give an opinion on whether we think the financial statements give a true and fair view. So if you want to get your best marks for the audit risk, you need to identify what is the area of the financial statements that could be wrong. If you don't do that, then potentially it's not an audit risk. But you also would, if you want to get good marks, say why that number is going to be over or understated. So how is it going to be wrong? And then what is the potential cause of this? Why is there an audit risk? Let's also remind ourselves about what an audit procedure is like. So examiners typically complain that audit procedures are a bit vague and therefore they don't give many marks, or perhaps they may give no mark at all. So if you want to have a good set of marks for an audit procedure, there are 3 components. You need to have a clear verb. What exactly are you going to be doing? And what is the evidence that you're going to be doing it to? And then what is the purpose of the procedure? What is it that you're trying to verify? Now, in terms of the verbs, there is a list of verbs in ISA 500. And there's a useful memory aid to help us try to remember these verbs, which are the 5 vowels, A, E, I, O, and U. So you should be able to describe most audit procedures using these 5 verbs. So the first one is that we're going to be performing analytical procedures. So remember, this is where we're doing some sort of trend analysis. So we're trying to set an expectation. What should this number look like? And that expectation may be based on, say, budget or the previous year. And then if the actual number is close to our expectation, then we can be pretty happy that it's not materially misstated. E is for inquire. So we're going to ask people questions. We may ask management questions, but it'd be better if we ask people who are outside the company. So we might ask a customer to confirm how much they owe, for example. I is for inspect. We're going to inspect contracts, inspect invoices, inspect assets to verify they're not damaged. We're going to observe. We may observe a procedure that is happening properly, or observe that an asset exists. And then U is that we're going to recalculate. Okay, Okay, apologies for the memory aid. But yes, so use recalculate. So we might recalculate depreciation, we might recalculate interest, for example. Now, another thing as well that auditors like to do is that they will agree one document to another. So imagine that we have a trail of documents. There may be a purchase order, which then becomes an invoice, which goes into the general ledger and eventually goes into the financial statements. So if we agree those documents along the trail, that will give us the comfort that we need that the number in the financial statements is not materially misstated. So again, if you want to get your good marks in the exam, try to make sure that you have all three components, that you've got a good, strong, clear verb. You specify exactly what is the evidence that you're going to be looking at, and then why is it that you're doing this test? What is it trying to achieve? So to answer this question, remember we need to use the information that's been given to us in the text to help us. So we identified some when we sort of looked at the information in the first place, and the first one we spotted is that this was the first year of our audit. So we could say as an audit risk that opening balances are misstated because it is the first year of our audit and we did not audit the balances last year. So notice we're following that three-part formula. What's the number that's wrong in the accounts? Opening balances. Are they over or understated? Well, it could be either way in this case, so I'm just putting misstated there. And then what's the cause of this? Because it's the first year of our audit. So that would be a nice strong answer. But remember, there are 3 areas we need to be looking at for 6 marks. So that's 1 mark out of 2, and 50% is a fail. So we need something else here as well. So we could also say that multiple balances are misstated because it is the first year of our audit and a lack of familiarity with the company causes detection risk. So we may not find the mistakes because we don't really know what's going on in the business. So while we're thinking about these, let's do the audit procedures for this particular area as well. So here are a couple of tests for opening balances. So we could agree the opening balances to the general ledger to verify their accuracy. So notice the 3 parts there. We've got the verb, agree, the evidence is the general ledger, and the purpose is to verify accuracy. And similarly, we could agree the opening balances to the prior year audited financial statements, again, to verify their accuracy. But what about the detection risk? So this is a slightly different procedure now because this is perhaps a bit more of an all-encompassing issue that we need to deal with. Because remember, we said that any number could be wrong because of this. So we need to ensure there's enough time allocated to the budget so that all the staff can spend that time understanding what's going on in the business and how it works. So let's move on to the second area now. So the second one we identified is that the finance director does not have any formal accountancy qualifications. So I think I could write about risks that, but just thinking in exam conditions, that might be a more tricky area to think about procedures. So it might be a bit better to focus on some of the more detailed areas that they've given us in the notes, because that's a little bit more concrete and might help us to create some risks and procedures. So you'll see in AAT's suggested solutions, they have talked about the lack of accountancy qualifications. So you can read up about that in their answers. But in terms of debriefing this now and showing you a technique that you could use in your exam, then yeah, these sorts of areas, looking at the numbers they've given us here and looking at the specific details, that's going to be a bit more specific for us and will help us to earn marks a bit more easily. So for example, we can see that there is no interest included in this year's accounts. But we saw, didn't we, that there should be some interest. Notice they've given us some numbers, and that can help us as well, because if we can calculate how much the number is, then we can see that the size of the potential error. So we're told, aren't we, that the loan amounts to £4 million and that the interest rate is 5%. So if we had that full £4 million and we hold it for the full amount of time, then that would give us an interest expense of £200,000. But it's not going to be that though, is it? Because we're told that the loan is being paid off monthly. So every time that we make a payment, the balance of the loan is getting smaller, and therefore each month we be accruing less interest. So that should be going down as well, because we only pay that 5% on the outstanding balance. So if we take the 4 million, and we're paying this off over 20 years, aren't we? So if we divide by the 20 years, then that tells us that we're going to be paying off 200,000 per year, and we're going to be paying that off monthly, so we want to divide by 12, and that tells us that we're going to be paying off £16,667 every month. So our loan balance is just going to be getting smaller and smaller over time. So remember, we're looking at this 10 months later. We took out the loan in April and we're now in January. So that means that we would be expecting 166,667 to have been paid off. So remember, we started off with our 4 million and we've paid off 166,667. So that means that at the end of the year, our loan balance should be 3,833,333. And remember, we'll be paying off the interest at some point as well. So that interest amount needs to be added on somewhere in this process, doesn't it? Okay, although it won't be the full 200,000, as we said, as the loan is being paid off, then the amount of interest we owe gets smaller as well. So looking at their numbers, we can see that there is no interest charged. And if you look at the non-current liabilities, well, that's not the number we had on our calculation just now, is it? So something's not right here. We don't know what's wrong, but something is not right here, and we need to recognise that as an audit risk. So let's have a look at the second box. So we can say that interest expenses are understated because none is shown in the accounts despite a new loan being taken. So again, notice the format. What's the number in the accounts? The interest expense. What's wrong with it? It's understated. And what's the cause of that? Because, well, there's nothing in the accounts there. And given they've given us numbers, I'm going to include a calculation here to earn a second mark. So we'd be expecting to see 166,000 in the accounts. And there's the calculation for that. And I'm just recognising there that it would actually be less than that because it's an amortising loan and we're paying some off each month. So I've said two things there to get my 2 marks. So we don't need to talk about this any further because we've got our 2 marks, but let's explore this a little bit more for the purposes of the debrief. So we could also say that the loan balance is understated because interest has not been added to the loan balance. So we identified, didn't we, that if they've got no interest expense, which they haven't shown in the P&L, then what's the other side of the double entry? So this is the correct double entry. They should debit the interest expense with the 166,000 and credit the loan liability with that as well. And if they haven't done the debit interest expense, then it would suggest they haven't also done the credit loan liability. And that's why the liability is smaller than we think it should be. So while this loan is in our head, let's do the audit procedures as well. So we want to start off by inspecting the loan agreement to verify the principal of 4 million, verify the interest rate of 5% and the payment terms that they're paying this off monthly. We could then inspect the bank statements to verify the interest payments occurrence. So we want to verify that they actually paid the interest. But remember that payment each month is going to be some capital and some interest, and we need to make sure we separate the two of them. So we'd want to recalculate the interest expense to verify the accuracy. using the 5% rate, but also taking into account that they're paying off some of the principal each month. And then having done that, we want to recalculate the loan balance to verify its valuation. And remember, they haven't posted some of these things, have we? So we want to verify these and agree these figures to the general ledger. Well, let's move on to our third risk. So while we're talking about the liabilities, we could also identify that perhaps the current liabilities look a bit different as well, but we don't really have much information about that, so I'd probably choose not to discuss the change in the current liabilities. In the AAT's answer, they have referred to that, and you can read about that yourself. But yeah, I think I would skip that in the exam because there's just too many unknowns here. What else could we do? Well, we've got all these figures. We could perform some analytical procedures between this year and last year to see whether or not these numbers make sense, whether they stack up or not. So let's have a look at that. Although, again, in the exam, I probably wouldn't do this because this is quite time consuming. But if you have time, it could be a worthwhile exercise. So let's show you how to do it. So here's the table they've given us, and remember that they've given us just 10 months for the first column. So what we need to do first of all then is recognize that we can't compare like we'd like. Here we have a year, we can't compare with 10 months. So what we need to do then is multiply all of these numbers by 12 over 10 so that we can perhaps compare a little bit more closely. So we can see then that the estimated annual amount for 20x4 will be 31,838. And we can see that that's therefore a 16% fall in revenue compared with the previous year. And if we've seen a 16% fall in their activity, we'd want to see that happening in all of their P&L. So if we do the same with cost of sales, here we're just expanding that for the 12 months, gives us 12,369, which is about the same really as prior year. So something doesn't really make sense here. So possibly our cost of sales figure is too big, or possibly our revenue is too small. But this just doesn't make sense. It doesn't stack up. Something seems to be wrong here. Okay, we don't really know what it is, but we'd need to investigate, wouldn't we? And then for our net profit before tax, so again, if we apply the 12 months, we get profit of 2,214, which is 17% bigger than last year. So again, that just doesn't stack up at all, does it? So if revenue's going down, but our costs are going up, we'd be expecting to make less profit, not more. So again, not really sure what's going on here, but yeah, there's definitely a clear audit risk that this just doesn't make any sense. So either revenue is understated or costs are overstated, but yeah, certainly it looks as if profit's going to be overstated. So an audit risk could be that profit is expected to increase by 17% despite extrapolated revenue decreasing by 16%. And that suggests that profits are overstated. Again, let's just emphasize that given that we had to do quite a few calculations to do that, that's possibly not an area that you should be focusing on in your attempt. So a typical audit procedure for the profit and loss account is to perform analytical procedures by examining month-by-month trends in revenue and costs to assess the reasonableness of the revenue and the expenses. So we want to see that it all sort of makes sense. If it's a seasonal business, then we would expect to see that sales and costs would be going up and down according to seasonality. Yeah, we know that in this case it's a car dealership, and so we'd expect to see sales going up in January and August when the new registration numbers are issued, for example. Remember, we need 2 marks to be able to do well here, so we could also agree the material revenue expenses to invoices, although we haven't said here what the purpose of that is, so that's going to be to verify their accuracy. and that the revenue actually exists. Now, the other thing we could also talk about, it tells us that the loan is being used to refurbish its business premises, and we can see that property, plant and equipment has gone up by a significant amount, which seems to confirm that. But in terms of the property, plant, equipment, you may know that we can capitalise the interest. So yeah, that could be part of the reason why there is no interest being charged here, because as long as that loan is directly attributable to the expenditure on that property, plant and equipment, then we could capitalise it rather than show it as an expense. We know that the finance director is not qualified, so that's quite a complicated area, and also something that's not been covered in your AAT study to date, so don't worry too much if you weren't sure about that. We also need to worry perhaps about the refurbishment, because is that really of a capital nature? Remember that we can capitalise any expense on property, plant, equipment, but not if it's simply maintenance. So if it was maintenance, then that should be shown in the profit and loss account and not capitalised. So the audit procedure for that would be to examine the invoices for whatever we're working on and verify they generally are of a capital nature and not of an expense nature. So as you can see, there's plenty to talk about here, lots of data available. The numbers are given, so you are expected to do something with it. But given that it's quite time consuming to do those calculations, you might want to consider talking about some of the other things instead. They only ask for 3 areas, and there are plenty for you to discuss here, so you could get full marks. So let's move on to part B of this question. So we spent quite a lot of time on part A already, haven't we? So identify whether the following statements about audit materiality are true or false. So the first one, when the prior year's external audit presented problems obtaining reliable audit evidence, it is appropriate to increase materiality for the current year's external audit. So let's remind ourselves first of all, what is the relationship between materiality and how much work we're going to do? So here's a sample size formula that auditors use. The sample size is going to be the size of the population we're auditing. We divide by materiality and multiply by a risk factor. Now for your AAT assessment, you don't have to worry about how you work out that risk factor, but anyway, that's the formula. So for example, if we're auditing a balance which is say £2,000 and our materiality is 100, and let's say for this purpose the risk factor is 1, so that means we would have a sample size of 20. Now, if we make our materiality smaller, let's suppose we make materiality 50, then that would effectively double the work we're going to do, because that's going to increase our sample size. Okay, so we just need to understand that materiality and the work we do are linked. Big materiality means that we do less work. Small materiality means we do more work. So in this case, it tells us that the prior year's external audit presented problems. So if we know there are problems, that means we need to do more work. And if we need to do more work, that means materiality should become smaller, not bigger. So that means this answer must be false. And then for the second one, it's appropriate to decrease materiality when the control risk is considered high because management consistently override internal controls. So there are problems in this business, so we need to do more work. And if we're doing more work, that means materiality needs to be smaller. So in this case, this is true. We can decrease materiality. Okay, we've got quite a bit of information for the next part as well. You've recently been working as a semi-senior on 2 separate external audit engagements. Below is an extract from the management accounts of both entities. So we've got revenue, land and buildings, and materiality. At Entity X, the directors revalued the land and buildings during the year and concluded that the valuation is 1.2 million. Comparable properties in the area are sold for about 1.8 million. The audit engagement partner has concluded that this is a material error. No other issues were identified in other balances or transactions in the financial statements. At entity Y, all the entity's land and buildings are located at the entity's manufacturing base in an area considered unsafe to visit. You are unable to conclude on the existence of land and buildings at the year-end date. The audit engagement partner has concluded that this is material and pervasive. No other issues were identified in other balances or transactions in the financial statements. So you identify whether these statements are true or false. So the potential misstatement at entity Y is pervasive because it affects more than one area of the financial statements. Well, what does pervasive mean? There are three meanings of pervasive. So the first meaning is that it affects everything in the financial statements. So every single number is wrong. The second meaning of pervasive is that it only affects a couple areas. It's got to be a couple areas, hasn't it? Because debits and credits, so there must be two areas that are wrong. But those areas are so big that they effectively dominate the whole of the financial statements. The third meaning of pervasive is that if it relates to disclosure, then the disclosure is fundamental to understanding the financial statements. While in entity Y, it's about the land and buildings, and that's not disclosure, is it? And we can also see that the land and buildings are just two numbers in the accounts, so that's not going to be covering everything, is it? But it could be quite a big number, although looking at the numbers here, it doesn't seem that this is particularly huge compared with revenue, let's say. But anyway, let's look at the statement again. The potential misstatement entity-wise is pervasive because it affects more than one area of the financial statements. Well, that's not the meaning of pervasive, is it? It should be covering every area of the financial statements. Okay, so by the nature of double entry, it's going to be affecting more than one area anyway, isn't it? So yeah, that's false. Okay, it's not enough that it just covers more than one area. The second statement then, both the potential misstatements are material to the financial statements. So we can see then that for the first one, we've got a valuation of 1.2 million. And in the area, they're being sold for 1.8 million. So that's a difference of 600,000, which is quite big, isn't it? So yeah, that's likely to influence the readers of the financial statements. So that would seem to be material. And then in the other one, so we've got the land and buildings, but we're just not sure that this number is okay because we've not been able to visit it. We can't even prove that the building exists. And again, that number is quite big. So that's likely to influence the readers of the financial statements. So yes, both of these potential misstatements are material. And then the third statement, the potential error at entity Y makes the financial statements misleading. So, well, we don't know whether they're right or wrong because we've not been able to visit. It could be it's right. But we just don't know. So yes, potentially they are misleading. Let's move on to part D now. Complete the following statements about audit risks. So something is the risk that the auditor selects a sample which is not representative of the population. So that's all about sampling, isn't it? And if we look at the answers, so we can see that one of the answers is sampling risk. So sampling risk is a subset of detection risk. Remember that detection risk is that the auditors don't find the mistakes themselves. And sampling risk is because they don't find the mistakes because they've chosen a bad sample. Remember, there's also non-sampling risk, which could be that the auditors are just incompetent or run out of time. But in this case, if they've chosen a non-representative sample, that would be sampling risk. And then next, the risk that financial statements contain a material error or omission due to factors other than the failure in internal control. So that's then something to do with the client rather than the auditor. So it's either going to be control or inherent risk. But it says it's not about problems in control, so that must be inherent risk. The risk that something is wrong just because of its nature. In part A, identify which of the following statements about recording techniques are considered to be an advantage or disadvantage. So in using internal control questionnaires, management may state what should happen rather than what does happen. So the idea of this is we want to find out how the company operates, and one way to do that is by using a questionnaire. So the questionnaire could be, do you do this, do you do this, do you do this? So we're a list of controls and we say, well, do they happen or not? But the problem is management may say, well, yes, we do that because we're just suggesting ideas to them, aren't we? Yeah. Do you have this control? Do you have this control? Do you have this control? They just say yes, yes, yes. So it could be that management say, yeah, yes, we do this, but actually they don't. So that's a possible problem because we're putting ideas in their head, aren't we? Yeah. Do you have these controls? They think, yeah, that happens, but actually it doesn't. Next then, the diagrammatic representation of a flowchart is easy to follow. So yeah, compared with words that describe what goes on, which could be pages and pages of description, that's not necessarily very easy to follow, is it? But in many cases, a diagram showing who does what, that can be easier to follow. So that's a good way of recording the controls. And then checklists tend to include irrelevant questions. Well, yeah, that's a problem, isn't it? That management have to go through the checklist and perhaps some of them aren't particularly relevant to their particular area of the business. So yeah, that could be a bit of a problem. We waste time on those irrelevant questions. And finally, for part F, identify which of the following recording techniques is best suited to the audit procedure you wish to perform. So you want to prepare a list of audit tests for the payroll section of the audit file. So should we use an audit checklist, a flowchart, or an internal control evaluation questionnaire? Well, in this case, if we want a list of audit tests, then an audit checklist is probably going to be the best way of doing that. We'll be able to download a list of standard payroll tests and we just choose which ones that we want to use for that. And then at the planning stage, you want to determine if internal controls are working effectively. Well, the flowchart will describe the controls, but it doesn't tell us whether it's good or not. So that's why we want to use this internal control evaluation, because it's going to be asking, do you have this control? Do you have this control? Do you have this control? If they say yes, 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 then that would suggest that they have good controls in place.